So last time we studied the basic idea of the no-arbitrage pricing theory using a fruit basket example. Today we are going to apply that idea to financial assets. So the following is our setting. There is company X, and company X's stock price or share price is currently priced £103. And the stock price can take one of the following three states tomorrow. State 1 is a good state and the company's stock price is £130. State 2 is still decent state, the stock price will be £120. State 3 is a bad state, company X's stock price is only £95. So no one knows which state will actually realize, but suppose everyone knows that one of the three states will realize tomorrow. There is also a risk-free bond that pays £110 tomorrow at each state, and this bond is currently priced £100. This bond is risk-free because it pays you £110 for sure, no matter what state realizes. There is also a call option available for company X's stock, and it can be exercised tomorrow at strike price £110. Remember what a call option is. Call option is a right to purchase something for a predetermined price at a predetermined date. In this case, the call option is a right to purchase what? Company X's stock. And the predetermined price, which is also called strike price, is £110, and the predetermined date is tomorrow. It can be exercised only tomorrow. So this is a very simple setting. We have only three possible states, 1, 2, 3, and we have only three securities, company X's stock, a risk-free bond, and a call option with strike price 110. Question: what should be the price of a call option with strike price £90? Note that this call option is different from the above call option. It is also a right to purchase company X's stock tomorrow, but the strike price is different. It's 90, so it's much lower than £110. So it's much better than the above call option. Let me summarize the setting. We have three assets and three possible states for tomorrow. The stock price is currently £103, and depending on the state tomorrow, its value can be £130 or £120 or £95. The bond, which is currently priced £100, will have value £110 regardless of the state. There is also a call option with strike price £110, which is currently priced £8. If state 1 realizes, the value of this call option, the right to purchase company X's stock for £110, is 20. Because with this call option, you can buy something that is worth £130 only by paying £110. So the difference, £20, is the value of this call option. Similarly, if state 2 realizes, the value of this call option is £10, because by exercising this call option, you can buy something worth £120 by paying only £110. Okay? So the difference is the value of this call option. If state 3 realizes, then this call option is worthless, rubbish, because there is no point of exercising this call option when you can buy this stock for £95 in the market. And our goal is to find the price of a call option with strike price £90, the price implied by the no-arbitrage pricing theory. But before answering that question, let me introduce a new concept of state contingent claim, or also known as Arrow-Debreu security, named after the two Nobel laureates Kenneth Arrow and Arrow-Debreu. You know, whenever I think of state contingent claim or Arrow-Debreu security, it reminds me of atom. You know, atom is uncuttable or indivisible. It's something that cannot be divided further. Remember that fruit basket example in the previous class. What was the atom in that story? Well, in a sense, the individual fruits were atoms, because all these bundles, all these fruit baskets were just a collection of individual fruits, apples and bananas and pineapples. So in that sense, these fruits were atoms. And what we saw in that example is that the prices of fruits baskets imply the prices of individual fruits, and the prices of individual fruits in turn imply the prices of new fruits baskets. When we studied bonds and interest rates, in one of the classes we studied how to derive yield curve from coupon bond prices. And in that story, atoms were actually discount bonds or zero coupon bonds. We studied that coupon bonds are just a basket of many discount bonds or zero coupon bonds. That is, the essence of what we studied in that class is that the prices of coupon bonds imply the prices of discount bonds, and the prices of discount bonds in turn imply the prices of other new coupon bonds. Now, for risky assets such as stocks, options, or corporate bonds, what is the atom? Well, Arrow-Debreu's idea is that it's state contingent claim. That is, all these risky assets can be simply regarded as a collection of many state contingent claims. Let me explain using our example. Again, in our setting, we have three assets currently traded in the market. In contrast, state contingent claim is an imaginary hypothetical asset which pays you £1 if a particular state realizes. So, for example, state 1 contingent claim is a security which looks like this. State 1 contingent claim says, if state 1 realizes, the owner of this claim can receive £1. There should be a signature of an issuer, whoever it is. Similarly, state 2 contingent claim is a paper which says the following. If state 2 realizes, then the owner of this paper can receive £1. Okay, same for state 3. Now, you might notice that the above stock can be regarded as a basket of many state contingent claims. A basket of 130 units of state 1 contingent claims and 120 units of state 2 contingent claims and 95 units of state 3 contingent claims. If you have that basket of state contingent claims, then if state 1 realizes, you will receive £130. If state 2 realizes, then you will receive £120. If state 3 realizes, then you will receive £95. The payoff is exactly the same as that of stock. Same thing can be said about the bond. The payoff of the bond can be replicated by a basket of state contingent claims, 110 units of each of the state contingent claims. Finally, this call option can be regarded as a collection of 20 and 10 and 0 units of these state contingent claims. In other words, the payoff of this call option can be replicated by a basket of these state contingent claims. The rest of the math is exactly identical to that of the fruits basket example. We had bundles, baskets of fruits, bundle A, bundle B, bundle C. We didn't know one apple's price or one banana's price or one pineapple's price. But we knew the prices of these baskets, bundles of fruits. And from the prices of bundles, we could derive one apple's price, one banana's price, and one pineapple's price. Yeah? We can do the same thing here. What I mean is the following. We can derive the prices of state contingent claims, the price of state 1 contingent claim, the price of state 2 contingent claim, and so on. We don't know these prices, but we have three bundles. We have a bundle of these state contingent claims. The bundle is called stock, and the current price of the bundle is £103. We have another bundle of these state contingent claims. The bundle is called a bond. The current price is 100. We have the third bundle called call option with the strike price 110, and it's a bundle of these state contingent claims. Because we have prices of these bundles of state contingent claims, we can derive the theoretical prices of state contingent claims. So let's denote the prices of these state contingent claims by P1, P2, and P3. By the way, the price of a state contingent claim can be simply called state price. So P1 is the price of state 1 contingent claim. So P1 is simply called state 1 price. Similarly, P2 is just state 2 price, the price of state 2 contingent claim. P3 is state 3 price. Okay, so let's derive these state prices P1, P2, and P3. This is the system of equations you have. The stock price is currently £103, and it's 130 units of state 1 contingent claim, whose price is P1, 120 units of state 2 contingent claims, whose price is P2, and 95 units of state 3 contingent claims, whose price is P3. Same for bond. The current price of the bond is £100. Theoretically, that price should be equal to 110 times state 1 price plus 110 times state 2 price plus 110 times state 3 price. The last equation is for the call option with strike price 110, and this is 20 times state 1 price plus 10 times state 2 price. You can solve it by force. You don't need matrix formulation, but if you use matrix formulation, then you can use Excel to get this inverse matrix. So you can use computer. State 1 price is 22.42 pence. State 2 price is approximately 35 pence. And state 3 price is approximately 33 pence. Again, the essential idea is that any asset is just a bundle of some state contingent claims. Once you get these state prices, theoretical prices of state contingent claims or atoms, you can compute prices of any options or other risky assets. For example, what is the price of a call option with strike price £90? Well, with such an option, the payoff will be £40 in state 1, the payoff will be £30 in state 2, and the payoff will be £5 in state 3. Then the theoretical price of such a call option should be simply 40 times P1 plus 30 times P2 plus 5 times P3. You substitute these numbers, the price is £21.18. Okay, that's the theoretical price of this call option with strike price 90. What about a put option? Let's consider a put option with strike price £125. A put option is a right to sell. So with this option, you can sell this stock for £125. If state 1 realizes the market price of the stock is 130, you can sell the stock for 130 in the market. There is no point of exercising this option to sell the stock for only 125. So the value of the put option will be 0 if state 1 realizes. If state 2 realizes, then the value of this put option is £5. Because if state 2 realizes, the stock price is £120. Okay? The stock can be sold for only 120. With this put option, you can sell it for 125. So the value of the put option is £5. If state 3 realizes, the stock price is very, very low. The market price of the stock is £95. Now the value of this put option is very high because you can sell something that is worth only £95 for as high as £125. The payoff from this put option will be £30 if state 3 realizes. So as a result, this put option can be regarded as a bundle of 0 units of state 1 contingent claims and 5 and 30 units of state 2 contingent claims and state 3 contingent claims, respectively. So the theoretical price of this put option should be 5 times state 2 price plus 30 times state 3 price. We substitute these numbers and we get the answer. The price of this put option should be 11.76 pounds. If the prices of these options are different from these theoretical prices, then there would be arbitrage opportunity. Investors can make free money by selling and buying these securities. The logic is very similar to what we saw in that fruits basket example, so let's see it some other time. Let me conclude today's class with a couple of remarks. In reality, only 3 possible states may be considered too rough an approximation. Even for tomorrow's stock price, there may be 10 different states. But there are also many call options and put options available for a variety of stock prices. So even if there are 10 possible states, if there are 10 assets, such as stock and call and put options, the math is essentially the same. You have just a system of equations, 10 equations with 10 arrow prices, 10 state prices. Or alternatively, you can shorten the time period from 1 day to 1 hour or 1 minute. Then only 2 or 3 possible states for the next period is not such a bad approximation. And this is actually a more popular approach.